Welcome. This is Tommy Ruke with part 2 of the 4-hour CE presentation for work comp consideration for motor carriers. If during the program you have any questions, please type them in the chat window and we'll attempt to answer them as we have time. If we do not have time during the program, we will email you answers later. Also, if you have technical problems, please call us or please type in the chat window if you have those concerns, or if you cannot type in the window because you don't have availability to the program, call 800-741-4084 and we'll attempt to correct the situations. In part 1, we pointed out that most state laws require employers to purchase work compensation insurance to pay for job-related injuries to their employees, with the employee being defined by state law. And depending on the state set number of employees, except for Texas and Oklahoma, that allows for opting out. What we're saying here is that if your insureds who meet the qualification as an employer in a state does not have work comp coverage, the state will come and shut them down and or fine them heavily. Texas and Oklahoma being the exception to that, where the employer can opt out. Tennessee is considering doing it also. Where we have the definition of numbers of employees, some states like California say any employment requires work comp. Some states have a numerical number, 4 to 3 to 5 employees, Texas, Florida, and some of those states. Each state has their own work compensation law that sets requirements for injuries in that state, meaning when will the state law apply to an injury. The policy must be set up to meet the state laws and provide the benefits due the worker that gets injured in that state or falls under the state law. Interstate motor carriers have employees in many states. This is one of the main complications of providing work comp to interstate carriers. When an employee is injured, they have an option of which state to claim under for the most part, meaning some states have an extraterritorial provision in it that will not accept it, but most states will accept one of these 4 considerations. And again, this is why, and this is the employee's option, not ours, not the insurance carriers. In fact, you can't even have them sign an affidavit or agreement in your employment contract that says, I will file a claim under this state law. That's been found unconstitutional in a number of states. They can file in the state they were hired in, the state they were employed in, the state they were injured in, or the state they reside in. For example, if you have employment where you have a recruiting office, say in North Carolina or Oklahoma, in fact, I just heard an advertisement for Walmart that said we are having a hiring situation where we're looking for truck drivers in Tulsa, Oklahoma at this location at this time. If you come and qualify there, then we'll give you a conditional job offer, and that will be the place of employment. But that driver that was hired in Tulsa, Oklahoma might be assigned to a Texas location. That would be where they were employed. They could be driving through Florida and get injured, or into Florida and get injured in Florida, or they could be living in Arizona or Arkansas. That's what we're talking about, a place of employment, a place of recruiting, the state they could be injured in, or the state the driver lives in. Those would be the ones that they could choose. Now, which state law would they choose in? Obviously, the answer to that in most cases is where you have the most benefits. But for non-catastrophic injuries, the states they reside in is where they would normally choose to collect, because that's where they're getting treatment, that's where they go home, that's where they rest. For catastrophic claims, the state that has the best benefits would be consideration. But the benefits don't vary as much as some of us think. All states require 100% of medical to be paid for job-related injuries. and also as the loss of wages, which is called indemnity payment. What the states say in most cases, and all of them within a couple of percentage points of this, is that we'll pay 66 2/3 of the last 13 weeks or 90 days of the worker's employment. And in most cases, that then is capped at, say, somewhere around $1,000 a week. It varies from $900 to $1,200 a week. So if you take 66 2/3 of a typical truck driver's wage, which even now is at 60% or 70, 60, 65%, 66 2/3 of that is not at the maximum level that states have. So where they would select indemnity payments wouldn't make that much difference, because their average weekly wage that the work comp system would have to pay would not be affected by any state maximum. They would get those amounts. The big difference is CAT claims, where they've reached maximum medical improvement, which is MMI, and now the states allow payment for injuries beyond what they have lost wages, now that they have been put back in medical condition where they aren't going to get any medically better, and then there's an impairment rating. Some states have for loss of eyes, loss of limb. Some other states have a percentage of the overall impairment rating, and that would be the balance that the carrier, the work comp system would still owe the worker after they've reached MMI, or the death benefits, which can vary greatly too. So for the typical claim that you have, most of the claims they have, there'll be no difference between what the states pay. It would only be the catastrophic claims and or the death claims that would be a benefit differences between what states pay. But since the employee has that option, we need to make sure we set up the employer's policy correctly. So now we're talking about setting up the policy. This is what we're going to discuss in this hour. Considering when setting up the policy, who is the employer? The entity who reports the employee's payment to the state or federal government for tax purposes. That's typically what's defined as a statutory employer, and they would be the employer of this worker. And we also need to look at what state laws must comply with. The state that is the place of employment, the state the driver passes through, or the state the driver lives in. So when we set the policy, those are the considerations. Who is the insured, which is the employer, and what state laws are going to be met by the work comp policy issued to this motor carrier, our insured. We set it up on the deck sheet, and we're going to look at the items on this deck sheet, particularly item 1, 3, and 4. Item 1, the insured. That's the employer. That's the person who pays the worker. That's the person whose tax ID number the worker's payroll is promulgated under and reported under. There's no other entity in the policy that gets, quote, protection from being an insured. Only the employer, because all the work comp addresses is the employee-employer relationship, so no one else would be involved in that. If there is certain provisions in the policy where certain individuals get the benefit of the work comp policy, meaning the tort immunity, which we'll talk more in the next section about what tort immunity means, but where it will not be subject to be sued by the injured worker. Those are established under and granted under the various state laws. So the policy that we would address and insured on the policy is the employer. You'd put no other entity there, and that's the tax ID number that the payroll is going to be reported under. So question to the motor carrier, what is the entity that pays the worker? Sometimes we might have, and we need to list that entity on the insured block and reflect their federal tax ID number. But we could have a situation where there might be more than one potential employer. And the statutory employer, that's the person who pays it. That's the person who pays taxes. That's the person who's identified and their entities by the tax ID number. But we do have situations here that would have common law. These are common law is you control the worker. And so we could have situations where we would have two operations, two entities, but one payroll, where you might have a motor carrier operating entity. You could have a separate leasing company, meaning equipment leasing company. You could have warehousing. Those could be set up as separate legal entity, but have operations to save tax purposes on one payroll and one furniture workers. Again, those are both controlled by the motor carrier, your insurer, of the same legal entity. We would want to make sure that other entities here are getting covered. Or more often what you'll have is your insured will use independent contractor, the owner-operator who provides their own work comp coverage. We'll talk about OCAC and those things later. Today we're talking about they do have their own work comp coverage, but they work under the direction of the motor carrier. So in that case, the independent contractor, the owner-operator, we're assuming in this case they probably have more than one employee. They would have 5 or 6 or more. All of them are leased to the motor carrier. They operate under the motor carrier's authority. Therefore, the motor carrier becomes a statutory, the common law employer, because they're controlling that worker. Later, also in the next section, you'll even see this federal law considers them an employee of that motor carrier who they're working for. And so in that case, even though you have a work comp covered on the owner-operator, could that owner-operator, could the independent contractor, the employee of that independent contractor, sue the common law employer of the motor carrier? The answer to that question is yes. So again, we would want to address that concern. Or they could use a staffing or employee leasing company or a driver service company. Those are the situations where you could have a common law employer, which would be the person who gives control over the operations of the employee. They tell them where to go, where to load, where to unload. They generate how much revenue is paid, yet they don't pay them. They're paid through the statutory employer. In those cases, what I suggest you might think about is adding the endorsement, the alternate employer endorsement to the policy. What this does is says that when that owner-operator, and this is the endorsement you can download and look at in detail. What that says is when we put it on the policy of the owner-operator, and the owner-operator's policy now covers the owner-operator, a legal entity, they're the employer of these drivers who now are leased to the motor carrier. What that says is if that driver makes a claim for work comp under the common law theory that motor carrier controls me, that the owner-operator's policy will address that injury, that claim made against the alternate employer, which in this case with the motor carrier. This is where you have the way this would work, because we'll talk more next session about the options that the independent contractor could have doing this, but that's what we have to worry about here, because you have the two and one policy would address that claim. This endorsement can be added to the work comp policy for either of the entities. It could be the statutory employer who's agreed to cover the work comp of the owner-operator, or it could be the vice versa, the owner-operator who could be naming the motor carrier, the common law employer, to their policy. All this clears up is that when an injury happens, sometimes a worker doesn't know exactly who they're working for, and or they might have opportunities to sue. Again, we're talking about as an employee of the different entities, not for other reasons that we'll talk about next time. Same situation for employee leasing companies or driver staffing companies who lend or lease workers to a motor carrier. The same situation. In those cases, it's common for the leasing company or the driver service to provide the work comp because they're a statutory employer, but obviously they're working for the fleet. That might be who they think they're working for, the worker, so therefore the fleet would be the common law employer, and that's why we use this endorsement. So they make a claim against the entity who pays them, no problem, if that entity has work comp. That's not the situation. That won't be a problem. That's what it's designed for. But they make a claim against the entity that controls them. This is who they're trying to claim against. The work comp policy of the statutory employer with the alternate employer endorsement now would address the claim for the common law, the alternate employer. So this is where it would work, where if they make the claim against the motor carrier who they're driving for, even though they're paid by the independent contractor, or they make a claim against the motor carrier they're driving for, even though they're a lease worker or they're provided by a driver service worker, the insurance policy purchased by the employee leasing company, the insurance policy purchased and provided by the owner-operator would address the claim of the motor carrier being the employer. There's no real additional exposure from the work comp carrier because all that's paid is the injury. So you haven't expanded your requirements of payment because all that's ever paid is the injury done. Now, are we picking up some additional employers? Not really, but because the work comp carrier needs to make sure they get the information from both the statutory employer and the worker of the alternate employer, the common law, so that both of the payrolls would be considered here. Both would be extended the tort immunity provided as work comp payment, as work comp, and the payroll will be considered that. We only worry about the payroll of the owner-operators while they're working for the motor carrier, not the other employees of the motor carrier, because it doesn't work. The alternate employer is not to cover the employee of the statutory employment of the motor carrier. It's just when they're using the owner-operators and they might consider or make a claim against the motor carrier. This clears that up. One policy covers both. Insurance carriers have not extended their or expanded their obligations to pay, because all that's going to be paid is the statutory limits, and they're getting premium for it because that's the worker they're getting premium for. So there's no additional exposure in that area. So it's something that I suggest you look into if you have more than one where you have a situation where there's a statutory employer and a common law employer, which happens often in the motor carriers industry because of the use of owner-operators, the use of driver services, the use of employee leasing companies. The next item is 3A and 3C. Work compensation, Part 1 of the policy applies to work comp laws of the state listed here. Again, we go back again. Remember, the worker has 4 potential states: state of hire, state of employment, the state of injury, the state of residence. Those states, since they have 4 options, must be addressed in 3A or 3C, which is all other states. That's what we're talking about here, the states that we need to list and the wording we need to list in 3A and 3C. If this is not done correctly, then we have no coverage for the injury that is happening when the worker makes a claim under a state law that's not covered by 3A or addressed by 3A or 3C. Block 2, 3A, work comp insurance. Lists all states in which insured has operations, known or expected, at policy issuance. Activities coverage required by compensation laws of those states. In other words, there's employment in that state. The insurance carrier must be an admitted licensed insurance carrier in that state to list the state in item 3A. And you cannot list the monopolistic states. So that's what we deal with trying to list it in 3A. But let's talk about the practical side of this in a minute. In 3C, we list the states that do not have a permanent place of employment at policy issuance, but they will have a worker in that state later. So it covers the operations of insured at either new locations or exposure beyond developed at the policy exposure. This would be the states that the worker drivers through. The insurance carrier for work comp does not have to be an admitted carrier in the state to list it in 3C. So 3A is where there's a permanent place of employment. The work comp carrier must be licensed to provide work comp and admitted carrier in the states listed in 3A. In 3C, all other states that the worker might find themselves in, mainly in the case we have here, are the states the driver will be driving through. Those will be listed in 3C. They do not have to be an admitted carrier to be listed in 3C. So let's talk about the practical setup of this. Policy only covers work comp obligations to states listed in 3A and 3C. If they're not listed there, folks, there's no coverage, which would create a problem because your insurance carrier now would be obligated to meet the laws of those states, and because the policy does not list those states in 3A or 3C, then there's no coverage for that claim made under that state law. Later we can talk about, or you can ask your carrier, would they go ahead and pay under the state laws that were listed in 3A and or 3C? Possibly. Could they pay? Well, maybe not, because again, you're meeting the state law requirements. So that's a situation that you would have to discuss with your insurance carrier about what their position would be. But technically, the policy would not address any injuries of a worker if the worker makes a claim under a state law and the state is not listed in 3A or 3C. 3A, known place of operation, must list all known operations, place for employment within 30 days of the policy effective date, or no coverage for that known location. They do give 30 days that you can add that state after the policy issuance, but after that 30 days, then if it's not listed in 3A as a permanent place of employment, they do not get protection under the work comp policy. So each year, dealing with your insured, you need to ask them, do you have recruiting offices? And if so, in which state? Beyond that, what does those recruiting officers do? If they make a conditional job offer, if they even say the words, yes, we will hire you, you meet our criteria, you have a job, but you got to go to Florida, you got to go to Tennessee, you got to go to Alabama, you got to go to North Carolina, you got to go to Texas to complete the employment at the terminal you're assigned to, that place where the job is offered, where they do the screening, where they do the underwriting, or excuse me, the application for employment is taken. That could be the state of employment. Do you have locations that the worker reports to for instructions, pay out of, or pick up loads that you own or control? This would be the home office. This would be the dispatch office. This would be where they go to have their vehicles inspected or the vehicles repaired. This is where they end up at the end of the day. They could load and unload there, but truckload carriers typically would not. The less than truckload carriers would, but that's a location they would have. And then thirdly, what state does the worker live in? We know those because we require MVRs. The employer requires an MVR for any driver who's a CDL driver. They know the state they live in. Those are the three states that the three situations where the state must be listed in 3A. The state they have a recruiting office in, the state that the driver is assigned to, they're paid out of, they come and park their truck there for inspection purposes, could be have it cleaned, to have it washed, where a garage operation is, to have it repaired. That's where you have in the 3A for that's the permanent place of location. And thirdly, it's a state they listed. Employers need to have a work comp policy with the above states listed, even if more than one policy has to be obtained, meaning you're dealing with a regional insurance company who cannot provide because they're not licensed in all states. They're not licensed in some states needed 3A, or you're using a you're using a state fund program like in Texas, Colorado, California, where those states are only licensed and admitted in the state that they are owned by, the state funds, that competitive funds in that state. They cannot list these other states because they're not an insurance carrier. In those cases, you'll have to go to another insurance provider for the balance of the payroll, or in some cases you might have to go to the assigned risk program to provide the needed 3A coverage. In 3C, these are all the other states, meaning we don't know their place of employment. It's not a recruiting state. It's not a state where we have a permanent locations that the driver gets paid out of or reports to or gets a vehicle report maintained. These are not the states they live in. These are the states that they might be found in during the policy period, which would give them an opportunity to be injured in that state. The suggested wording you would have is all states except monopolistic and states designated in item 3 of the information page. That would be then all terminology we use is all other states. Technically, the term that you is the other states coverage, meaning other states then listed in 3A. This coverage is designed to provide coverage for unknown or temporary exposure, meaning if they started a new office, recruiting offices during the year, or if they purchased a terminal, or they have a terminal location, or have a contract with a customer that was generated after the policy inception that requires them to have a staging yard or a staging area adjacent to the customer's location that the driver goes through to park to be ready to move into the loading, unloading facilities of the customers. That could be considered a place of employment, or more often we deal with is the place that the driver drives through. There are some considerations by some insurance carriers that say we don't list them in 3C because, and then they don't tell you why. And the one reason they might say is because we're not admitted. Again, you do not have to be an admitted work comp carrier in that state to list it in 3C. Legitimately might say, well, we're not comfortable with that state law. We don't feel that we can properly address a claim in the state law. Our adjusters don't understand the state law. Those are things that are legitimate discussion, but not because you're not an admitted carrier in that state. The reason you don't have to be in the carrying state is what the 3C says, and this is the wording out of the policy, or paraphrasing the wording out of policy about 3C. It only applies if a state's shown in 3C, and again, not monopolistic states. It applies if you begin work after policy issuance, meaning it's not something that you have a work location at policy issuance. Company will reimburse you if they cannot directly pay. That provision 3 is why you do not need to be an admitted carrier, because what would happen is the employer, which is your insured, would pay, and then the employee work comp carrier will reimburse them for that payment. In reality, what happens, the insurance company steps in and pays on behalf of the employer, even though they're not licensed to do so in that state, and takes over the claim. But because they have the reimbursement provision in it, the work comp carrier does not have to be an admitted carrier in 3C. It also says you must notify us within 30 days effective of the policy for states where work already exists and that state is not listed in 3A. This makes it important, imperative that you find out each year, because if there's work existing in the state at policy issuance, you do not move it up to 3A in 30 days. Even though it's still listed in 3C, you don't have coverage anymore for that known place of employment. This is the this 3C is just for unknown, meaning states the driver drives through. Again, imperative that you visit with your insureds prior to policy inception each year to find out where they have a place of employment, where they have a place of recruiting, where the drivers they live, and the states the drivers might find themselves in during the policy period, listing them properly in 3A or 3C. We have the other provisions here, and again, that's the 3A where you list the states with permanent place of employment. 3C is all other states except the states that are monopolistic states, and the states listed in the 3A. The middle part of that page, which is the employee liability coverage, is coverage that where you could have tort immunity that is not effective, meaning that the worker can sue. We'll talk more about tort immunity and the concept of immunity in our next section, but sometimes the worker covered by work comp can sue. Again, the worker who would normally cover work comp. It's not oftenly done. It's not done uniformly in all states, but there are in every state law provisions that says yes, they can sue, even though the work comp extends toward immunity because, and that is the because. And they use words like substantially certain or virtually certain. What that means is the employer knows they're putting the worker in a position that will injure them, and therefore they make the worker go to that location or in that situation, and they know they'll be injured. The example that I have actually seen is where we had an insured who was cleaning out tankers, and they were sending the employees down inside the tanker. And they had 2 instances where even with the respirator, the employer got sick, they got hurt because they were inside that tanker. And then yet they still sent other employees into that tanker without taking steps to prevent those things. That's a substantial certainty, a virtually certainty. We knew the worker would be injured when we were there. Therefore, what the states say, yes, we give tort immunity for normal employment, even for gross negligence on behalf of the insured, in this case the motor carrier. However, if they go beyond what's common, if they go beyond and know they put an employee in a situation where they're going to get injured, then we're not going to have the tort immunity extended to them. So therefore, the work comp policy will have employee liability coverage that will step up and pay for that injury. It's the same worker that's covered by work comp. It does not cover independent contractors. It's the same workers. It's in the same states as covered in 3A and or 3C. The reason you have to have this is there's no coverage in the liability forms of GL and auto liability for tort cases, because both forms have a injury to employee exclusion that says if the employee gets injured, then we do not pay under auto liability or general liability. So this buys that back, but it's very rarely used, and states depend on how strong that law is, and so you need to check with your individual lawyers who handle your insurance work or your insurers work comp claims in those states to find out which states have tort immunity breached and what are the circumstances that would breach tort immunity to allow tort to determine what your exposure is. The limit is 100, 300, and 100 there. Most of the places we look for them, a million. Most umbrella carriers require that, but that's where you would list that. That's what the purpose of that item 4 in the deck sheet. So concern. If known place of employment at policy inception, they're not listed in 3A, then no coverage, even if state is listed in 3C. If known at policy inception, still no coverage. Update 3A each year. 3A, place of employment, home state of all drivers is one that we forget often. 3C, all other states that they might travel through. That's how we list it. If states in 3C are not moved to 3A at policy inception for new exposures, then there's no coverage even though state 3C is still listed. If not listed, will the insurance carrier pay the benefits of states that are listed and collect the premium for? Answer is maybe. Part of it might be determine how big the exposure is and what's the differences in the exposure. But you need to talk about your carriers if they're unwilling to list the states that you think need to be listed. Again, remember the differences, except for catastrophic differences and for death benefits, aren't all that much different between the various states. Then we get to premium. The premium for this policy will be determined by our manual rules, classification rates, and rate pages. There are 3 items that make up the premium. The first off is the classification. Are they drivers, 7219, or that's the over-the-road truck driver? You have the local truck driving. You could be mechanics. You could be office. You could be sales. If they have a warehousing facility, it could be warehousing. When you look at classification, be very careful, because a lot of cases in the trucker classification, it'll be the 7219 will be NOC, which will pick up not only the driver but also the mechanic. So a lot of times they try to split that out. That you need to discuss with your carrier going in, how they classify all your workers beyond just the driver themselves. Most of laws allow, or classification do allow the breakout of clerical and sales, but in the trucking industry, the drivers would be considered as well as mechanics under the prevailing class. The second consideration is the rates. It would be the rates of the state. There are 2 types of rates. Fixed rates like Florida, which says everybody charges the same. The other rates would be based on something called lost cost, and the insurance carrier would add a factor to lost cost to cover profits, overhead, those items. Lost cost is just what the rating bureau, NCCI, says this is how much premium you need to cover these many injuries for this classification, with nothing built into it other than payment of the claim itself. And then you have remuneration. That's what the worker gets paid. So we look at the three things. You need to clear up what the classifications is, what state laws and the rates of the state laws that the premium will be generated under, and then what is remuneration. So block 3 from the deck, definition of what constitutes remuneration as defined by NCCI, not the insured. You'll find that is unique to that part. Most of the time the driver would not get paid by the hour. Sometimes mechanic would. Most of the times the driver is paid by percentage of the load. And here we're talking about driver. If it's a mechanic that falls under theirs, that has this, they're an exempt from overtime. Employees involved in interstate motor carrier involved in interstate commerce, that's the key. The driver is involved in interstate commerce, not the local driver, but they leave the state. Or if the mechanics works on vehicles that leave the state, then their time is not subject to overtime if they're paid by the hour. But in trucking, most of the time they're paid by percentage of the load. And the work comp system recognizes that there is an expense that the driver has to bear themselves when they're, quote, away from home, unquote. That's called a per diem. This is what's allowed by the work comp bureaus that says what payment is made to cover the expenses of the driver, either substantiated by receipts being brought in and or an estimate cost that's reasonable cost, that part can be paid as a per diem and is not subject to work comp because it's not considered remuneration. If the state lists, if the work comp carrier lists the states in 3C, then payroll and premium and the carrier must pay taxes to that state. So those are the concerns that we have here is if we list it in 3A, then the work comp carrier has to report payroll and has to pay taxes based on that premium developed by the payroll in states listed in 3A. And second is, what's the definition of remuneration? And particularly what we're dealing with is the provisions for per diem. So you want to make sure we have assignment of the payroll for the proper states of operation and coverage under item 3A and 3C. If there's only one state, that's 3A, no problem. That's all you have. Then payroll is only applied to that one state. If more than one state, then payroll for premium purposes are assigned as follows. This is the NCCI rule. This can be changed at audit, meaning that even though you don't have it listed in 3A or 3C, or the carrier can come back at audit time and change those items, those listings, and charge premium based on these three considerations. Base terminal. The payroll of the driver, chauffeur, and helper shall be designated to the state of the base terminal. However, the definition of base terminal is not what we would normally think in our industry, particularly we, the insurance providers of truckload carriers. Base terminal is a permanent location with certain loading docks and or central, loading docks and or storage facilities where a motor carrier regularly goes to load and or store, transfer freight. In the real world, a truckload carrier would have a base terminal, but not, a less than truckload carrier would have a base terminal, but no truckload carrier. They might have a parking area, an office with parking area. They might have a facility for garage maintenance and those items, but that doesn't meet the definition of base terminal from the audit rule. Again, LTL truck carriers would have it, but not truckload carriers. The driver takes their truck home. They don't pick up a load. They pick up loads from their customers. They unload at their customer's location. Even though the place that you as insurance provider go talk to the insured is called their terminal, it's not the terminal as defined by the work comp audit system. The second option would be majority of time traveled in a state. If it can be established that a motor carrier spends a majority of driving time in a specific state, the driver's payroll shall be assigned to that state. Then we go back to what we all understand to look at what states the driver drives in, and that's the if-then reports. Yes, that could be a mechanism here. And it could be a mechanism particularly if you have situations, and again, I use these without being making any judgment about the viability of this, but they're based on what I'm hearing from you guys, the differences between rate in Indiana and Illinois is significant. The premium significance is different. There's a lot of motor carriers who are domiciled in Indiana and try to have a less rate charge because the Indiana rate is less, but the driver spends most of their time driving in Illinois. This is a situation here is where the work comp carrier is not comfortable with the Indiana rate, but they see through IFTAs that the driver spends most of their time in Illinois. They can charge the Illinois rate that they have to that payroll of those drivers that spend the majority of their time in Illinois, as reflected in the IFTA reports, not where they have their headquarters, not the address, not the location that's shown in 3A. And that's an example here. And again, IFTAs can be done that, but that's not easy found either. The third option, and this is the one that some of us don't look at, one that I'm dealing with right now, is a state of residence of the driver. If the base terminal or state of majority driving time cannot be established and the motor carrier is traveling from his state of residence, payroll shall be assigned to the state of residence. Definition, state of residence. The state in which the motor carrier resides is evidenced by the location used for filing federal income taxes, and that would be the state that they would have on their driver's license. So that's the third option. I'm dealing with a situation right now that was written in a policy written in Florida in the assigned risk, where the auditor came back and said, whoa, we have drivers in Florida, we have drivers in Georgia, we have drivers in North Carolina, we have drivers in Tennessee. I'm going to assign the payroll of those drivers that we have in those states, not just Florida, that you have Florida listed, but since you have it in 3C, we're going to redo the payrolls in those states, which is significant differences in some of those states' comp premium. And this was done at audit time. So this needs to be cleared up. This is a major exposure you have, mainly because the drivers drive through many states, and the way we set the policy up gives some latitude or some ability for the insurance carrier to assign payroll to states, and we want to know up front how that is happening. So the real-world situation. Most less than truckload LTL carriers will generally qualify for a base terminal. Truckload carriers will not. Motor carriers will also not have a regular run where the driver spends majority of their driving time in any state. So therefore, the place of residence of a truckload carrier, since the driver takes the vehicle home, the driver does paperwork, the driver calls in on their home phone or the cell phone at their home location for dispatching purposes, the driver would take their vehicle in for maintenance and or fuel from their home or not, their home, the resident comes to the place of employment. So easy, state of residence reflected in the employment file on the driver's license. But that might not be their home office state. That might not be where you deal with them all the time. That might not be where they're clerical and the rest of where they're actually establishing it. And it might not be where the most of the exposure is. Again, they could live close to the border. They could live in Brunswick, South Carolina, Georgia, and they spend most of the time in Florida because they're dealing with a Jacksonville location, and they pick up loads in the South Georgia area and drive into Miami area. That's the kind of things you need to look at. They might not be where they will be driving most of the time, so that is what we need to factor in. So it's not an exact science. It has these options, and anytime you have options, it's imperative, I feel, that the insurance carrier and the insured should get together going in and determine how this is going to be properly allocated. So conclusion, if not done properly, the insured can face a major premium audit exposure, and for the insurance carrier, uncollected premium. That's not comfortable ever. for anybody. The two factors that could create this is what state payroll is determined on, and is the worker an employee or independent contractor which does not generate work comp premium. That we're going to discuss in the next hour. But right now we're only talking about the state of the payroll. So you could, if you don't set up the states properly, if you don't understand where the audit's going to be charged, you could have coverage and audit consideration. Clear this up front when you issue the policy. As long as the insured and the insurance carrier agree, then there's no problem. Make sure the insured understand which state rates the payroll will be applied to. Can use IFTA for the majority of driving time the states the drivers will be in. You can look at the residence of the employees, the drivers, on their MVR. If the insured and the insurer agree at policy inception, then there's no problems because they all agree to that and everybody understands that. And the work comp carrier can agree, yeah, our rates in Illinois are fine. We don't care if the driver spends most of the time in Indiana, the Illinois rate's fine, or the Florida rate meets our exposure. We don't care if they're in Georgia or Alabama or South Carolina. That would be a function of, are we getting enough premium, where they're spending the time and the benefits we have to pay, the ability to pay those benefits properly, and are we comfortable with that? As long as they understand, then there's no problem. If there's a problem, then it goes to some kind of rating bureau and those things. One other consideration that we'll address later is the independent contractor leased to the motor carrier. Will they be an employee or not? Again, that will be defined by what is an employee in various states. We'll talk about that next hour. But you need to address this up front to make sure that everybody understands. And the more employees, the more drivers your insured has, the more this is important, because that's as they expand their pooling, recruiting areas, they then would have these other exposures. Let's look at not remuneration. This is exclusion C of the NCCI manual. States have rating bureaus that could vary this slightly. But what this says, this is not considered payroll from a premium standpoint. Expense reimbursed to employees to the extent that an employer's records confirm that the expense was incurred as a valid business expense. That's if you have the exact record. If they have the hotel room, if they have the food receipts, if they have the showers or the other things they do away from their home for their own body care and all that, then that is an expense, parking area expense where they park their vehicle. Or we could have reimbursed expenses and a flat expense allowance, except for hand or handheld power tools. That's not relevant here. Paid to the employees made by excluding from the audit only if all three of these following conditions are met. The expenses are incurred for the business of the employer, meaning since the driver has to be away from home for every 11 hours they drive, 14 hours they work, they have to spend 10 hours away from home. So therefore, the expense they incur for the food for those 10 hours when they're away, for rest, for food, for nourishment, for cleaning, even for laundry, those things would be considered an expense that was expended on behalf of the employer, because in the trucking and over-the-road truck drivers have to have that term. And the amount of each employee expense reimbursement is a fair estimate. That's the key word, a fair estimate. But then when we do this, then you have this situation where the employee or your insured needs to have two payroll setups where we report to the audit for audit purposes and also tax purposes. One that is considered driver pay remuneration and one for the reimbursement of expenses per diem. You need to look at it. NCCI today only allows $30 per day. Some state rating bureaus allow more than that. The federal government allows more than that. So you could have three separate payroll records. One, the driver's pay, one payroll record where a per diem is allowed, which does not become taxable because of the expenses away, and those numbers are in excess of $50 to $60 a day. And third is for work comp purposes. And so if you need to set your insured up so they report it properly, here's the driver pay, here's the per diem pay, and then the tax pay depends on what they tell their taxing advisors on how to handle that. but it's amount per day. You cannot take a percentage. You can't say this is, we're going to take 10% or 8% of what I pay to be considered per diem. You could do that on an accrual basis, but at the very end you must trust up and take the numbers of days. How do we know the numbers of days in their way? Well, again, that's what the that's what the log books reflect, and that will take up to whatever's allowed. Again, NCCI states allow $30. If the driver gets injured, this is another concern you have though, the driver pay that's part of per diem is not part of their average weekly wage. And a lot of times they consider that part of their wage, and that's one of the places that can be contested by when they get a lawyer when they don't think they're getting fair payment as for their loss of wages. So that's based on the 13 weeks of the previous 13 weeks of employment or 90 days of employment in most cases. So you need to explain to the driver that we're going to give you 2 payrolls. This is the payroll that's going to be based on for work comp purposes, and will based on the payroll that you would get for your average weekly wage, and your per diem won't be a part of that, but the per diem is something that you don't have to pay taxes on. You also need to talk to your tax advisor to see if your insurer needs to 1099 those per diems. A lot of times that has to be done that way, particularly if they're insured as an individual. If they're LLCs or corporations, maybe not. So again, per diem is allowed. It's allowed up to NCCI $30 for days away from home. It can be a significant premium savings if it's done properly, but you need to do it properly and get those understanding from everybody. So recap, state laws have different requirements. So you need to make sure that you list the state laws there's an exposure in. Policy needs to be set up to make sure an interstate motor carrier has coverage in all states they have exposure in. Place of employment, place of recruiting, where the drivers live, or the states they drive through. 3A is the place of employment. Every year you need to talk to a driver, to your insurance. Where do you have locations? Where do you have recruiting offices? Where do you have places the driver goes to pick up their paychecks? They're assigned to their dispatch office, where they go to have their vehicles maintained, it's owned and controlled by you, the insured. And what states do your drivers live in? You need to list those in 3A. Any other states you need to list the drivers can be found in, you need to be listed in 3C. Again, recommendation is all states other than the states listed in 3A and the monopolistic states. Premium consideration, make sure at policy inception that all insurance, agent, and carriers agree on which states rates will be applied, what is remuneration, and who's an independent contractor, which is what we're going to discuss the next hours. Work compensation road carrier is one of the hardest types of insurance to provide, as most deal with all states. Could also use non-employees. At least the motor carrier does not think they're employees, but might later be considered an employee by the injured worker or employee and the insurance carrier. And our next hour will address the exposure this exposure that's unique to motor carriers, that's use of owner-operators, independent contractors.